You wake up each morning, check your investment portfolio, and tell yourself everything's fine. The experts on TV reassure you the economy is strong, that these market fluctuations are normal. But there's that nagging feeling in your gut, isn't there? That sense something fundamental has shifted, that the rules you've trusted your entire financial life suddenly don't apply anymore. You're right to be concerned. What I'm about to share with you isn't speculation or fear-mongering. It's a pattern I've traced through centuries of economic history, a sequence of events I call the seven-stage collapse pattern. This exact pattern has preceded every major economic collapse from the Dutch tulip bubble of the 1630s to the 2008 financial crisis. And right now, the United States is firmly in stage 5, with only 2 stages remaining before the full systemic reset that few are prepared for. While financial advisors tell you to stay invested and politicians promise economic strength, the historical evidence shows we're running out of time before the inevitable conclusion of this cycle. In the next few minutes, I'll walk you through each stage, show you the irrefutable evidence of where we stand, and most importantly, reveal what happens next based on this repeating pattern throughout financial history. Let's go back to Amsterdam in the 1630s. The Dutch Republic was experiencing what many historians consider the world's first recorded speculative bubble. Tulip bulbs, originally imported from the Ottoman Empire, became status symbols among the Dutch elite. At first, price increases seemed rational. New tulip varieties were genuinely rare, and wealthy merchants were willing to pay premium prices for unique flowers. But what started as legitimate demand transformed into something else entirely. By 1636, tulip prices entered what we now recognize as stage 1 of the collapse pattern, the euphoria phase. Regular tulip bulbs that previously cost the equivalent of a few dollars were suddenly trading for the price of luxury homes. Ordinary citizens, not just wealthy merchants, began borrowing heavily to speculate on tulip prices, believing they could get rich quickly by flipping bulbs to someone else for even higher prices. The market disconnected entirely from the underlying value of the asset. A single Semper Augustus bulb sold for enough to buy a mansion on Amsterdam's finest canal. By February 1637, the pattern reached its inevitable conclusion. The market collapsed virtually overnight, with prices falling over 99% in a matter of weeks. Those who had borrowed heavily were financially ruined. What's critical to understand is not just that a bubble formed and burst, but the specific sequence of events that preceded the collapse. I need to pause here for a moment, because I can almost feel what you're thinking right now. That sinking feeling in your stomach as you recognize these patterns in today's economy. You're not alone in this. I hear from viewers every day who say they've felt this same unease, but couldn't quite put their finger on why. Let me ask you directly, which warning sign I've mentioned so far resonates most with your personal experience? Your insight helps others in our community recognize these signals in their own lives. Drop a comment with the warning sign that concerns me most is. And share your perspective. Your comment might be exactly what someone else needs to read to finally take action before it's too late. The pattern I've identified doesn't just apply to exotic financial assets like tulips. Let's examine the Mississippi bubble of 1719 to 1720. France was struggling with massive debt after the wars of Louis XIV. John Law, a Scottish financier, convinced the French regent that he could revitalize the economy through a national bank that issued paper money. Initially, this innovation seemed brilliant. Law established the Mississippi Company, which held a monopoly on trade with French Louisiana. As shares in the company rose, the French economy appeared to boom. But looking carefully at the sequence of events, we can identify the same pattern emerging. Stage 1, the euphoria phase, gave way to Stage 2, the credit expansion phase. The national bank printed more currency to meet the demand for Mississippi Company shares, effectively creating money out of thin air. This influx of easy credit pushed asset prices to unsustainable levels. Shares that originally sold for 500 livres reached 10,000 livres within months. The French aristocracy, middle class, and even servants poured their savings into the company, believing prosperity would continue indefinitely. What's particularly instructive about this example is how the government actively participated in the delusion. The French regent himself took large positions in the company and encouraged others to do the same, just as we see governments today promoting retirement investments in overvalued markets. By early 1720, the pattern progressed to Stage 3, the insider extraction phase. Those with inside knowledge, including Law himself, began quietly converting their paper shares to physical assets like gold, land, and commodities. When the public noticed this behavior, confidence wavered. The pattern then accelerated through stage 4, the panic onset, when the bank restricted the conversion of notes to precious metals. Within months, share prices collapsed by over 90%, the currency became virtually worthless, and the French economy plunged into a depression that lasted years. We see this same 7-stage pattern repeat with remarkable precision in the 1929 stock market crash. The Roaring Twenties exemplified Stage 1's euphoria, with stocks rising over 400% in the decade. The mass psychology was undeniable, with ordinary Americans believing the market could only go up. Stage 2's credit expansion manifested through margin lending, allowing investors to purchase stocks with just 10% down. By 1929, Americans had borrowed an unprecedented $8.5 billion for stock speculation, equivalent to over $130 billion today. Stage 3's insider extraction was evident when Paul Warburg, a prominent banker, warned of a coming crash and quietly reduced his exposure, while Joseph Kennedy famously sold positions after receiving stock tips from a shoeshine boy. Less known is that in September 1929, inner circle members of the financial elite began liquidating positions while publicly maintaining optimistic outlooks. The pattern progressed predictably through Stage 4 when the market dropped 11% on Black Thursday. Stage 5, which I call the false recovery phase, occurred when banks and major investors temporarily stabilized the market, leading many to believe the worst was over. Newspapers ran reassuring headlines. Financial experts urged buying the dip. Sound familiar? The New York Times on October 26, 1929, quoted a leading economist saying, "The decline is purely technical and not based on any adverse change in the country's business outlook." What followed was Stage 6, the capitulation phase, with Black Monday and Black Tuesday wiping out all remaining market confidence. Stage 7, the systemic reset, saw unemployment reach 25% and the Dow lose 89% of its value from peak to trough, fundamentally restructuring the entire financial system. If you're finding value in this analysis so far, take a quick second to hit that subscribe button. We're just getting to the most important part, and I want to make sure you receive our future updates as this pattern continues to unfold. Now let's break down each stage of the 7-stage collapse pattern more systematically, so you can clearly understand where we are today. Stage 1, the euphoria phase, is characterized by rapidly rising asset prices, widespread public participation in markets, and a strong belief that this time is different. We see the normalization of historically extreme valuations and the emergence of new financial paradigms that supposedly justify these valuations. Traditional metrics like price-to-earnings ratios or price-to-sales are dismissed as outdated. New narratives emerge to explain why historical limits no longer apply, such as the new economy in the late 1990s or the Fed put in recent years. Stage 2, the credit expansion phase, involves central banks and financial institutions dramatically increasing the money supply and loosening lending standards. Easy money fuels further asset price inflation, creating a feedback loop. Consumer debt reaches record levels, while savings rates decline to historical lows. The critical element in this stage is the exponential growth in leverage throughout the system, with each new dollar of debt producing less economic output than the previous dollar. Stage 3, the insider extraction phase, is when institutional investors, corporate executives, and financial elites begin quietly reducing their exposure to inflated assets. We see record levels of insider selling, unusual patterns in dark pool trading, and the strategic conversion of paper wealth to hard assets. The key behavioral marker is the growing divergence between the public statements of financial leaders and their private actions. Stage 4, the panic onset, begins with an initial sharp correction that catches most investors by surprise. This is typically triggered by an event that forces recognition of underlying economic realities, such as the failure of a major institution or unexpected policy shift. Stage 5, the false recovery phase, is where I believe America stands today. This stage is particularly dangerous because it creates widespread complacency. After the initial shock of Stage 4, central banks and governments intervene aggressively to stabilize markets. They cut interest rates, inject liquidity, or implement stimulus programs. Markets partially recover, often regaining 40 to 70% of their losses. Financial media declares the worst is over. The public is told that economic fundamentals remain strong. But beneath the surface, critical structural problems remain unaddressed. Debt continues to grow. Economic indicators like velocity of money, labor force participation, and real wages tell a different story than headline numbers. During this stage, we see growing divergence between financial markets and the real economy experienced by ordinary citizens. The average person struggles with rising costs and stagnant wages, while asset markets suggest prosperity. This divergence creates social and political tensions that further destabilize the system. Stage 6, the capitulation phase, occurs when a secondary trigger, often seemingly smaller than the initial Stage 4 event, breaks the facade of recovery. This trigger typically exposes the failure of intervention measures to solve fundamental problems. Market declines during this phase are more severe and sustained than in Stage 4. Public panic gives way to resignation as confidence in financial institutions and government intervention collapses. We witness forced liquidations, margin calls, and the unwinding of leveraged positions on a massive scale. The contagion spreads across asset classes that were previously thought to be uncorrelated, as entities sell whatever they can, not what they want to. The most concerning aspect of Stage 6 is how quickly it can unfold, typically condensing financial damage that might normally take years into weeks or even days. The velocity of decline accelerates as algorithmic trading, ETF structures, and derivatives magnify selling pressure in ways that didn't exist in earlier historical Please. Stage 7, the systemic reset, represents the complete restructuring of the economic system. This isn't just a severe bear market or recession, but a fundamental shift in the rules of the game. Previous assumptions about markets, currencies, and investments no longer apply. We see the implementation of new financial regulations, potential currency reforms, debt jubilees, or even the introduction of entirely new monetary systems. Asset prices reach true fundamental values, often 80 to 90% below their Stage 1 peaks when measured in real purchasing power. Those who entered Stage 7 with limited debt and significant ownership of essential assets emerge in relatively stronger positions, while leveraged paper wealth can be permanently impaired. The transfer of assets from weak hands to strong hands creates a new financial hierarchy that often persists for decades. Most importantly, Stage 7 resets the societal contract around money and value, establishing new frameworks that initially restore confidence but eventually set the stage for the next cycle to begin. Now, let's examine the evidence that America is currently in Stage 5, the false recovery phase. After the initial market panic of March 2020, when the S&P 500 dropped 35% in just 23 days, we've seen massive intervention. The Federal Reserve expanded its balance sheet by nearly $5 trillion, more than doubling its previous size. Congress approved multiple stimulus packages totaling over $5 trillion. This created the textbook Stage 5 recovery, with markets rebounding dramatically and even reaching new highs. Headlines proclaimed economic resilience and the power of monetary policy. But look beneath the surface. Real wages, when properly adjusted for inflation using consistent methodologies from the 1980s, have declined for most Americans despite nominal increases. The labor force participation rate remains well below pre-pandemic levels. The velocity of money, a measure of how quickly currency circulates through the economy, has plummeted to historic lows, indicating fundamental economic weakness despite massive liquidity injections. Most tellingly, we're seeing classic Stage 5 divergences between insider behavior and public narrative. Corporate executives sold personal shares at record levels throughout 2021 and 2022, while their companies spent billions on stock buybacks, effectively transferring corporate cash to personal accounts at elevated valuations. In 2021 alone, insider selling reached $69 billion, an all-time record that was 30% higher than any previous year. Major institutional investors have quietly increased allocations to gold, commodities, and inflation-protected securities while publicly maintaining bullish equity outlooks. Central banks globally have been net purchasers of gold for 13 consecutive quarters, the longest streak in modern financial history. They're not doing this because they expect the current monetary system to remain stable. Perhaps most concerning is the acceleration of wealth concentration that typically occurs in Stage 5. The top 1% of Americans now own more wealth than the entire middle class combined for the first time in recorded history. This isn't just a social issue, it's a critical economic indicator. In every historical example I've studied, extreme wealth inequality peaks just before the transition from Stage 5 to Stage 6. It represents the maximum extraction of wealth from the system by those with early access to newly created money and insider information. When this extraction reaches its limit, the system becomes too unstable to maintain the illusion of recovery. Additional evidence where in Stage 5 includes the proliferation of zombie companies, corporations that don't earn enough to cover their interest payments. By the end of 2022, zombies represented 19% of publicly traded companies, compared to just 2% in the 1990s. The normalization of extraordinary monetary policies like negative real interest rates, previously considered temporary emergency measures, is another hallmark of late Stage 5. Most people don't realize these policies represent desperate attempts to maintain the status quo rather than signs of economic strength. What happens next based on historical patterns is alarming. The transition from Stage 5 to Stage 6 typically occurs when a seemingly manageable problem suddenly reveals itself as systemic. In 1929, it was the collapse of leveraged investment trusts. In 2008, it was the realization that subprime mortgages weren't an isolated issue but had contaminated the entire financial system. Today, potential triggers include the commercial real estate market, where vacancy rates in major cities remain at depression levels while loans come due at much higher interest rates. The office vacancy rate in San Francisco exceeds 32%, higher than during the dot-com bust, while over $1.5 trillion in commercial mortgages will need refinancing in the next 3 years at interest rates often double what they were originally. Another candidate is the fragile treasury market, where declining foreign demand and massive new issuance create the potential for failed auctions or liquidity crises. The derivatives market, with hundreds of trillions in notional value built on increasingly shaky foundations, represents perhaps the greatest systemic risk. Once Stage 6 begins, events will likely accelerate rapidly. Historical patterns suggest market declines of 50 to 70% from current levels, not in years but in months. Credit markets typically freeze, with corporate borrowing becoming prohibitively expensive or completely unavailable for all but the strongest entities. Unemployment historically doubles or triples from pre-crisis levels. The government response to these developments actually accelerates the progression to Stage 7, as desperate fiscal and monetary interventions undermine remaining confidence in currency stability. Stage 7, the systemic reset, will fundamentally transform America's economic landscape. Based on historical precedents, we can expect significant changes to monetary policy, potentially including a new currency system anchored to hard assets to rebuild lost confidence. Debt restructuring, whether explicitly through jubilees or implicitly through inflation and financial repression, will be necessary given the mathematical impossibility of repaying current obligations under normal economic conditions. Wealth disparities typically compress dramatically during Stage 7, through both the destruction of paper wealth at the top and social policy changes aimed at preventing civil unrest. For those paying close attention, we can already see early warning signs that the transition to Stage May 6 be approaching. These include the growing divergence between consumer sentiment and market performance, increased volatility in previously stable markets like short-term treasuries, and subtle shifts in language from central bankers. The Federal Reserve's recent emphasis on the need for higher rates for longer represents an acknowledgement that previous inflationary pressures were not transitory as initially claimed. It's crucial to understand that while this pattern has repeated throughout history, the specific timeline can vary. The transition from Stage 5 to Stage 7 has historically taken between 6 and 36 months. Variables affecting this timeline include the level of government intervention, central bank credibility, and external factors like geopolitical stability. What remains consistent is not the exact timing but the sequence and ultimate outcome. The technological tools available to central banks and governments today may allow them to extend Stage 5 longer than would have been possible in previous cycles, but they cannot prevent the progression to Stage 6 and 7. The warning signs I've shared today aren't meant to paralyze you with fear, but to empower you with knowledge. Every week on this channel, I break down another critical economic pattern and provide specific actions you can take to protect yourself and your family. If you're the type of person who values preparation over panic, subscribe now. While others will be caught off guard by what's coming, our subscribers are quietly taking measured steps to secure their financial future. Join our growing community of financially resilient viewers by hitting subscribe and tapping the notification bell. Your future self will thank you for the small action you take today. Remember, throughout history, those who recognized these patterns early didn't just survive economic resets, they positioned themselves to thrive in the new system that emerged. The same opportunity exists today for those willing to see what's happening and act accordingly. I'm committed to providing you with historical context and clear-eyed analysis of what's really happening to our economy. No hype, no unnecessary alarmism, just the patterns and facts that matter to your financial survival. Subscribe now and gain the knowledge that puts you ahead of the crowd. In times like these, being early to understand is everything.